Hey everyone, this week we'll dive into Alphabet's quantitative factors to complement the last week's podcast about Alphabet too, and that one talked about qualitative factors. So let's go. We will focus on the growth sources that are measurable and most significant. And the first one is growth from industry shifts. This topic was discussed previously when assessing Facebook's growth because the core business of both companies is advertising. There is an ongoing shift to digital advertising due to the superior precision of digital ad targeting. And back then I wrote, but I expect Facebook to grab a cut of offline ads because I think that online advertising is more effective than offline ad targeting. If you put up a local radio ad, the best you can expect is to be talking to everyone in a specific region. With online ads, I can talk, for example, to mothers of teenagers using iPhones in that same region. We will now make two assumptions about the future, as we did with Facebook when we were estimating how much Facebook would grab from this shift from offline to online advertising. And the two implicit assumptions are that digital advertising market share will reach 75% of all advertising in 2030. The second one is that Alphabet will take 25 to 30% of that shift based on their digital advertising market share of over 30%. And by doing that, we arrive at an amount of $70 to $80 billion of future top-line growth. To complement these assumptions, you can check the written post at stockpickinginsights.com. You will see a table there with market data about how much historically it has been spent digitally and offline, and the total market size, and also its growth. Alphabet will also benefit from shifts from physical to cloud. Cloud is a very big umbrella term for all the services associated with using Alphabet servers and IT teams instead of buying or hiring your own teams. Google Compute Engine, and that is virtual machines, and Google Cloud Storage, and that means literally storage, are probably the most used of them all. Cloud is taking away market from physical servers and IT teams, and we have many of these two assets in place from all the years before cloud services existed. There is still huge opportunity for a shift from physical to cloud, hence the spectacular growth that we have been seeing in Azure, GCP, and AWS, the major cloud players. We can also try to measure how big of an opportunity it is. And to do that, we will recur to some historical data. And on the written post at stockpickinginsights.com, you have a chart. This one comes from Statista. And if that chart represents all the historical sales of physical servers by the major players. And if you sum all of those values, you arrive to 580 billion, and that is since Q1 09. Yet, I do think that this value is underestimated by looking at Dell's 10 case in 2020. You will see $36 billion of revenue in infrastructure, but the chart says that they only have sold 14 billion. We also have to add in all the assets in place pre-Q1 09 without having data about it, so we have to assume that part. Remember that we are not trying to be precisely right, we simply want to estimate how big of an opportunity it is. And if you take since Q1 09 until 2020, you have the 580 billion of physical servers sold. If we estimate that from 1995 up until Q1 09, 200 of physical servers have been sold. And if you also consider that they are underestimating some of the data that we are recurring to is underestimated, and if you add 100 billion because of that, you arrive at 800 to 900 billion of physical servers sold since the beginnings of internet for consumers. And that doesn't take into account all the money invested in IT teams to support that capex. Now, will cloud represent 50% of those physical assets in 10 years? I think it's reasonable to say yes, considering the main advantages of cloud, that is scalability and no upfront capex nor IT teams. Some of it will be due to shifts from current assets in place, and some of them will be from simply emerging businesses. So half of the physical server current assets in place means 450 billion roughly. If you discount the current market of infrastructure as a service and platform as a service, that is currently $115 billion. That leaves 300 to 350 billion for the taking in the next decade. Considering that GCP's cloud market share is 9%, so we won't consider that they will get better than the competitors. We will simply forecast that they will maintain their market share, and that means that they will bring $30 billion of new revenue from cloud. You might find this value conservative at the rate that GCP is growing, and it probably is. Another huge source of revenue, and this one is, I would say, more predictable, is Alphabet's growth from YouTube. YouTube is a major source of growth, and it doesn't take a lot of guessing to see the potential for the next decade. At the time of writing, they have over 2 billion monthly active users with a 5-year CAGR, compound annual growth rate, of 14%. And you have a chart that in the written post that illustrates that. You'll see historically the CAGR 5-year rolling periods for YouTube. It is conservative to forecast 3 to 3.5 billion monthly active users, MAU, in 2030, considering the current adoption rate, new future internet users, and that 3.5 billion represents 70% of today's worldwide internet users, which I would say it isn't much considering the great product YouTube is. That gives us a CAGR of 3 to 4% as opposed to the 14% that we've been seeing historically for the next 10 years, and top line growth of 30 to 50 billion dollars because of it. This transfer from growth in users to revenue is done by starting with the revenue that they are making with the current MAU, monthly active users, and then just doing a linear interpolation for the new amount of monthly active users. In the written post, you also have a chart, and that chart shows that revenue is growing faster than MAU for YouTube. And this can be due to many reasons, one of them being ad relevance, generating more clicks. And you can visit the Facebook's written post for further explanation of what I'm talking about. It can also be due to volume of ads shown, ad spending shifts from other platforms to YouTube, and these are just a few explanations. That means that the 30 to 50 billion forecast of top line growth due to YouTube will probably be on the higher end. There are also unmeasurable sources of revenue, as there was with Facebook, but these are too important to not talk about, and I'm talking about ad relevance, akin to pricing power in the tobacco industry. More relevant ads generate better returns on investment for advertisers and ultimately for Alphabet. But how can we forecast how much revenue it will bring? It is hard to say. It depends on how well the human capital will do on improving Alphabet's products. Directionally speaking, it will probably be a tailwind for revenue, and that's good. Ad volume is the second one. We can only take so many ads, and time will tell how many, and if we are already saturated of the volume of ads. Not the ideal source of growth, in my opinion, contrasted by ad relevance. Ad relevance is the best source of growth for Alphabet. It is a shame that we can't measure it objectively. To sum it all up, we have new revenue from industry shifts, digitalization, the shifts from offline advertising to online advertising, that's $70 to $80 billion. Then we have industry shifts from physical servers and IT teams to cloud and Alphabet's own IT teams, and that's $30 billion. And finally, you have YouTube, MAU growth, and that's monthly active users. That should bring about $30 to $50 billion of revenue. Adding all this up, you get $130 to $160 billion of revenue. So at least there should be at least $130 billion of new revenue for Alphabet coming in until 2030, so for the next 10 years. And that's a 6% CAGR for Alphabet's growth in revenue. Is it probably higher? Yes, due to both the conservative estimates that we've made and unmeasurable sources of revenue. So this should put a floor on how much Alphabet's top line will grow. And that is it, guys. If you would like to check the written version of this podcast, you go to stockpickinginsights.com, and we'll see you next week.